Hello and welcome to Portfolio Matters Weekly Update, week 39. And it has been a dramatic week in the markets. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Yes, well, it's been a very interesting week in the market, and energy markets have been really astonishing. And frankly, as I was going through updating some of these charts, and some of them made me feel physically ill, we are entering a period of very high energy prices that's going to have huge knock-on effects to global economies, particularly in the EU. But before we get into that, this week's economic data. Now, the only real piece of economic news was Janet Yellen coming out saying that the US government will run out of money by the 18th of October unless they get an agreement to raise the debt ceiling. Now, historically, they've always come to an agreement, and the consequences of a US government bond default would be truly catastrophic. So you have to think that they will somehow cobble something together, though it may be at the last minute.
I'm sure they will. They always do cobble something together, Keith. But what it is indicative of is the insatiable appetite of the US economy for debt.
Yeah. Okay, let's go through some data. So US new home sales grew 1.5% month on month in August, which is well down on the 6.4% figure for July, but actually beat expectations. So the good news is that US new home sales are growing again. After the timber price has collapsed and people have the cost of building new houses has returned to more normal levels. Okay, US durable goods orders rose 1.8% month on month in August, up from July and well beating expectations. So that's very good. The US Dallas Fed manufacturing index for September fell substantially to 4.6 from 9 in August and massively beat expectations. The previous numbers, the durable goods orders number, was for August. And I think what we're now seeing is that high energy prices and continued supply chain disruption are having negative effects on industrial output. And those numbers are coming through in September. Also in the US, we have July house price growth figures, and those are amazing. US house prices grew 19.9% year on year in July, and month on month, they grew 1.5% in July, building on 2% in June, and that beat expectations. Now, in the UK, we had consumer confidence numbers for September, and they weren't good. -13, which is worse than -8 in August and substantially worse than expectations. And clearly, all the supply chain disruption and the rising energy prices are starting to affect consumer confidence in the UK. We have UK mortgage lending figures for August, and that bounced back strongly. It was plus 5.3 billion from minus 1.8 billion in July, and that beat expectations. Remember that the June number was absolutely astonishing. It was the biggest lending in history, in recorded history. So things have normalized a bit since then. In the EU, industrial sentiment for August was strong at plus 14.1, up from July and beating expectations, and services sentiment weakened slightly but remained strong. EU unemployment rate in August was 7.5%, which is high by UK and US standards, but when we show you the graph in a minute, you'll see actually that's quite low by EU standards, and the EU economy is actually doing quite well. Now, other big news on inflation was in German inflation ticked up to a new high. In September, the number is 4.1%, up from 3.9% in August, but meeting expectations.
I think it's the highest level in 29 years, Keith.
Yeah. And in Germany, the IFO Business Climate Survey is rolling over. So it was 98.8 in September, down from August, though slightly beating expectations. In China, the Caixin manufacturing PMIs came in for September, and they were 50, up from August and slightly beating expectations. So perhaps that is a sign that the Chinese economy is stabilizing. We also have some quarterly data, which is actually more interesting. So UK GDP growth in Q2 was plus 5.5%, which bounced back from a contraction of minus 1.4% in Q1 and beat expectations. So that's good. Business investment rose 4.5% in Q2, whereas in Q1 it actually contracted by 10.7%. And that number beat expectations, which was also good. Now in the US GDP grew 6.7% in the second quarter. And in the first quarter, it grew 6.3%. And bear in mind, in the UK GDP had contracted by 1.4% in Q1. So the US economy is doing much, much better than the UK economy.
I'd just like to chip in here, Keith, and say that this is always, and I say this regularly, this is always predicated on whether the inflation number is accurately recorded. And if you go to alternative inflation numbers in the US, they're up between 10 and 12%. So if you took those figures, then the US would be either not growing or in contraction. Now, I'm not saying those numbers are right. What I am saying is I'm dubious that the US economy is actually growing as fast as these figures suggest, because I think they significantly understate inflation.
But the figure I found astonishing is the next one. US corporate profits quarter on quarter rose 10.5% in Q2. And that is a quarter on quarter number. And we'll show you the chart in a second, having grown by 4.7% in Q1. And that beat expectations. So US corporate profits have been absolutely astonishingly strong. And we had US PCE inflation for Q2. And remember, that is the Fed's favored inflation measure, personal consumption expenditure inflation. That rose 6.5% in Q2, up from 3.8%, but it met expectations. So US inflation is strong.
But it's only transitory, Keith.
Haha. No, Richard, it's now frustrating. Okay, so the Fed is finding the continued high levels of inflation frustrating. They are sitting on their hands and it's not coming down by itself. Amazing.
What a surprise. What a surprise.
So these are US new home sales, and they have bounced back a bit from their lows.
Yeah.
This is the Dallas Fed Manufacturing Index, and you can see that it is continuing down, I'm afraid. And frankly, given what's happening to energy prices and continued supply chain disruption, you worry that that's only going to get worse. UK mortgage lending bounced back towards normality after the absolutely extraordinary gyrations earlier in the year. US housing starts continue strong. Now, US consumer confidence is rolling over again. EU industrial sentiment looks good, but frankly, those are the numbers for August. I really think that these are going to start rolling over. Services sentiment was coming off. And has China bottomed? Has the Chinese manufacturing and services sectors, have they bottomed? They had a little tick up in September. This is the EU unemployment rate, which is very high by British and American standards, but by EU standards, actually, that looks really good.
Yeah.
And US initial jobless claims have actually ticked up over the last few weeks. This is weekly numbers. Now, remember that there are massively more job openings in the US than there are potential employees, unemployed people to fill them. So this is slightly surprising and something we should monitor going forward. And this is the quarterly profits data. And it seemed astonishing. So I checked, but yes, we have had over 10% corporate profit growth in Q2. And in Q1, there was 4.5%, but again, strong. And, look at this, we're now 20% more profitable than we were 3 years ago during the last, when the economy was running normally. But in Germany, the business climate surveys are rolling over. So something to watch. And frankly, I think that's going to get a lot worse. And because we'll show you the electricity prices in Germany, and they are frightening. Okay, so in previous weeks, we've been debating what macroeconomic environment we have been in. And Richard had said we're heading into stagflation. And I said we can't have stagflation because if we have stagflation, interest rates will rise and they will kill the economy, and we will instead get volatility. Now, right now, Richard is very much winning the argument. So interest rates are rising, but they remain astonishingly low. So we'll show you later that the UK 10-year yield is around 1.3%, whereas CPI is at 4%, and the Bank of England is saying they expect it to continue that way well into 2022. So how do you invest in a stagflationary environment? Well, what you want to do is you want to own assets that are price insensitive. So as the price rises, people are still going to want to buy them. And you want to avoid anything that's got interest rate risk, like the plague. So if you have any bonds, and we have been advising against holding bonds since the start of this podcast, really not good.
I think, Keith, we should point out that we think we're probably at around about 10 o'clock on this chart, don't we? We've got slowing growth. We suspect we have slowing growth and rising inflation. We've definitely got rising inflation. We don't know. We know we have rising inflation, and the transitory argument is looking more and more foolish, I think, as every week goes by, because all the input costs that you care to look at are going up. We've got food price inflation, energy inflation, lorry driver shortage, staff shortages. So I think we can discount transitory, whatever transitory inflation is. I think we can discount that. Inflation is here and it's going to be around for a while. What's different on this occasion is that I don't think central banks can raise interest rates. So the market can try to raise them, but central banks can't, because there's so much debt.
So I'm going to push back on your comment that it's foolish, Richard. I'm going to say the word transitory looks increasingly political.
Yes.
So it looks like they will just keep on using the word transitory for as long as the market believes them.
Yeah, and then they'll change the word.
Yes, too frustrating, whatever. But what they won't do is actually raise interest rates for all the reasons Richard has outlined.
Jolly surprising would be a good. So coming back to that, and if you look at, I don't know about anything about emerging bond spreads. I wouldn't like to comment on that. Inflation protected bonds, clearly, yes. Gold and commodities. So commodities are behaving as you would expect them to behave with increasing inflation. Gold currently isn't, but I suspect that gold will begin to.
Yes. No, performance of precious metals has been a puzzle. But then, frankly, so is the performance of bonds. They got stronger even as inflation was rising. But tips, inflation-protected bonds are incredibly expensive. And if you buy those, you will be locking in a guaranteed real loss every year you hold them.
Is that right?
Yeah.
So tips are not something that people should be putting in their portfolio, although theoretically they should be. It's too late.
It's too late, essentially. You can, if you think inflation is going to get even worse and you're happy to lock in, -2 or -3%, actually, I think it's -3% now, ad infinitum, then, perhaps that's the trade you might want to consider. I personally think there are much better ways of protecting your wealth. But frankly, I think that is the key point now. You're now in an environment where you're looking to protect your wealth rather than to make money. Okay, now moving on to China's energy crisis. Everyone's having an energy crisis, but it is also not just the EU, it is China. So China is heavily dependent on coal. So it consumes about 50% of total world coal consumption. And that's a problem because just like everywhere else, the price of coal has gone through the roof. So
now, I know that recently the Chinese government has told generators that they can't pass the energy, the price of coal increase on in their price of electricity. And even more recently, I think they've now told them that they can pass it on to manufacturers, but manufacturers can't pass it on to consumers. So the Chinese government is absolutely petrified of consumer price inflation.
Well, they can say those things, but then those companies are going to go bust. The power generators and the manufacturers are going to go bust. And you're going to have strong state intervention in the economy. Let's see what happens, Richard.
Yes.
And the reason that China has a problem is that the white line is Chinese electricity consumption of coal, and the blue line is Chinese coal production. And so you see the Chinese now have a shortage. And then they had this political spat with Australia and stopped importing. As a result, you have massive supply chain disruption, and 20 provinces comprising 66% of Chinese GDP have now announced power curbs on industrial users. Now that is inflation coming down the pipe. You are going to restrict supply, and therefore if demand stays anywhere near the same, you're going to get inflation. And this is various charts of Chinese output, and in each chart what you're looking at is the red line, which is 2021. Now you'll see Chinese cement production, crude steel production, they're all dropping, and that's only going to get worse. On that cheery note, we'll move on to the Eurozone economy, which actually is doing okay. So these are all charts from the FT, and this is a chart showing mobility data from Google. And you can see actually people are now moving around pretty much the same they were pre-pandemic. Cinema revenues have recovered almost back to where they were in 2019. Although bear in mind, this is revenues as opposed to visits. COVID infections are falling again, despite kids returning to school. Air travel seems to have stabilized, so it didn't dip with the Delta variant. Although
on that though, Keith, is that it may have stabilized, but I'm guessing it's stabilized at a level which is unprofitable for the airline industry.
Well, I'm not so sure about that, Richard. Given my flights to Greece next month,
they put the prices up.
They put prices up absolutely enormously. 500. Well, it's costing me and my family £500 return to Crete each. Yeah. Each.
So clearly that's how they're coping with it. And how inflationary is that? Everything that's happening is there's nothing that's going on in this world at the moment that is deflationary, pushing prices down.
Yeah. And before anyone asks, that I'm not going by private jet. I'm going by Ryanair from Luton, and they did charge me extra for all my luggage at that price.
That is extraordinary, Keith. It really is extraordinary.
Yeah. The one bad spot in the Eurozone economy is German truck mileage, which is a function of how many manufactured goods are being moved around from German factories, and that has been drifting down essentially, although it's ticked up recently. Frankly, with electricity prices doing what they're doing now, I really think that's going to roll over again. But the OECD data, and they're using live data, so this is a nowcast, they are all showing that economic activity is improving and is getting back towards pre-pandemic levels. And job vacancies look strong everywhere apart from Spain. But in Germany, France, and Italy, they are all well above pre-pandemic levels. But that's all that data is backward looking. And this is a really, really frightening chart. Now, we did this last week, and the price was about 90. And then this week, it is absolutely shot up. Now, bear in mind, this is German electricity 1 year ahead. This is not today. This is not the spot market.
So this means this is what people will be paying in 1 year's time, assuming that their electricity suppliers have fixed their pricing in the market. Yeah. Which any electricity supplier who hasn't fixed their prices forward at the moment, and gas supplier, is heading for bankruptcy.
Yeah. So what this is basically saying is there's too much power demand, and some factories are going to have to go offline. Simple as that. You're going to drive out the least profitable and most energy intensive manufacturing sectors. And if we go to a more granular view, well, it doesn't look much better, frankly.
No.
You know,
there is insufficient energy to go around.
Yeah.
And it doesn't really matter what happens to prices. There's still, as long as demand doesn't change, there is insufficient energy to go around. The prices will continue to go up until, as Keith says, at some point, people will be forced out of the market entirely.
Yeah. Now, in part, so if you look at a breakdown of what is called pushing up EU electricity prices, it is mainly the gas price, but it is also carbon taxes.
So, Keith, I think I mentioned a couple of weeks ago, now I don't believe this is the time to be invested in EU carbon credits. And I did have some, and I sold them. I think I mentioned that a couple of weeks ago. And I believe the EU will have no option but to backtrack on its carbon tax. And effectively, the price of the fuel is doing the job for them. They don't need the carbon tax. And it's completely intellectually, economically, probably morally unsustainable to continue with the plans, the current EU plans for the carbon tax. And I think when we look at the graph of energy prices, sorry, the map of energy prices you have later, that reinforces my view.
Yeah. The trouble is, Richard, that EU governments are making a lot of money out of the carbon tax.
But their citizens will begin to riot, Keith.
Well, actually, I think that's true.
Especially with winter coming.
Well, and these are today's, so this is the 1st of October 2021, and these are live European electricity prices. Now, in Spain, you're talking about 216 euros per megawatt hour. You're falling to 100 in Germany. So actually, prices the highest down south in the poorer regions of Europe. And just a quick reminder that last year, you're talking about 40 euros. Okay, so Southern Europe now above 200 euros. That is a 5-fold increase on last year. But in normal running, Germany has the highest electricity prices in the EU because despite all their green credentials, they closed down all the nuclear power stations and are now burning brown coal.
Which was an act of lunacy. And actually, even more so an act of lunacy now, because I don't think they can restart their nuclear reactors. They've been mothballed for many years. And they have completely shafted themselves, as was perfectly obvious at the time, I have to say.
Yes, I agree with that.
What's her name? Thunberg doesn't say anything about it, though, does she? Greta.
Yeah, no, Richard, but, she doesn't have her remit does not involve, social cohesion and poverty.
No, it doesn't, does it?
It's like if ever we all revert to living in a yurt, I think Greta would be quite happy.
Without antibiotics, Keith.
Now, but did you know, we've been doing all these charts of the EU saying, oh God, aren't they in a bad way? We are even worse. We're at the end of the line and one of our interconnectors has gone down. Okay, so after that cheery note, let's move on to silicon prices because, we need a lot of silicon for the green energy transition to solar.
Keith, how expensive can sand be?
Well, absolutely, Richard. Surely sand can't go through the roof, but there you go. It has gone up 5-fold since mid last year, and something we have covered before, but let's reiterate. Production of polysilicon is a function of coal. Essentially, what you do is you mix your sand or quartz with coal, and then you put it in an electric arc furnace, and you get out carbon monoxide and pure silicon. And producing polysilicon ingots requires a lot of coal. So you put in 1,000 kilos of sand and 550 kilograms of coal, and you get out roughly about 450 kilograms of polysilicon. So inflation is appearing absolutely everywhere. Now, moving on to some other charts. Richard, do you want to take this?
I just wanted to talk about Evergrande generally. I mean, just as a brief summary, Evergrande has got about 300 billion of bonds, which it's most likely to default on. It's been one of the principal builders of the ghost cities in China. And as people probably know, those apartments have been bought by Chinese citizens because they have a speculative interest in the prices going up. So it is effectively a Ponzi scheme. And when that Ponzi scheme ceases to work, then obviously the price comes crashing down. But in this case, Evergrande's cash flow has ceased and it can't service its debt. So I'd just like to make 2 comments on this. One is clearly Evergrande isn't the only builder who has been speculating this way. And we don't really know, well, I don't know how many others there are and what the size of the problem is. And secondly, I read an article recently that suggested that Evergrande has very large off-balance sheet liabilities. In other words, it's not 300 billion, it's a lot more than 300 billion. And those off-balance sheet liabilities can lie all over the place and you have no idea where they are. But if you take those 2 factors and say, what is the real liability in the Chinese economy of a impending property bust? It is much, much bigger than 300 billion. And I think the Chinese government is actually petrified. And I don't think it could control this if it goes wrong. And I think one of the reasons they're so desperate to stop inflation coming into the economy is because they can't cope with 2 major economic upheavals simultaneously. And I think they have a real problem. And that is a feeling I have.
Well, certainly the Evergrande crisis seems to have completely disappeared from people's minds as other crises are appearing everywhere, but it's not gone away. As we talked about when we covered Evergrande, this will be slow burn. You won't see, they'll suppress the symptoms for absolutely as long as they can. Now, the Chinese credit impulse, are there signs it is bottoming? And, we've previously shown that manufacturing PMIs took a little tick up this month. Richard?
Chinese bank loans to property developers. It reinforces the point I was making that the Chinese economy is hugely exposed to what I think is an unstable property sector.
Well, this is precisely the dynamics of the GFC, Great Financial Crisis. Property, problems in the property sector, overextended banks, kaboom. But the red line here is estimated Chinese property inventory levels, and they're not elevated. And the blue line is turnover, and turnover in terms of months of sales is actually quite low. So there's no signs of a build-up in unsold properties in China.
So I think this graph is actually a very confusing graph and very difficult to interpret. But if you look at the blue line, estimated inventory turnover on the right-hand side, it's saying that inventory turns over in 18 months. If you're a property company, and let's say you run on a 3-month working capital cycle, and you've got an 18-month inventory turnover, and for some reason your sales cycle stops, then you have 15 months of inventory which is effectively unfunded. You have a huge cash flow problem, an enormous cash flow problem. And to say that the relatively low inventories point to no major supply-demand imbalance is entirely missing the point. The absolute inventories are huge.
Very good point, Richard.
Okay, so Chinese manufacturing sector has dipped into contraction. I mean, we've talked about energy demand, energy consumption, energy availability, and it would be very surprising if power supplies are being limited to manufacturing industry if they didn't then go into contraction. So I suspect that we're going to see that line extending downwards in the next couple of months.
Frankly, I think you're going to see it extending very sharply downwards.
I would just comment here that, just as a general comment, we've got a world economy that went into COVID in a relatively, I would say, relatively unstable state because there's so much debt in the system and overvaluation of financial assets. And you take a complex system with emergent properties and you chuck the COVID pandemic at it, and you chuck a bit of money at it, and you think everything's going to come out hunky-dory. Well, it's not. You just don't know what the consequences of it will be, but you can be pretty certain that it's going to be highly disruptive and you're going to get all sorts of effects coming out that you couldn't possibly predict. And I think that's what we're seeing now, and I don't think we're any way through it.
No, I agree with you, Richard. Now, you remember that the transport sector is generally seen as a good indicator of global activity. So if the economy is doing well, they need to move loads of goods and people around. And so transport shares are a decent indicator of activity. And FedEx this week, its share price has taken a bath, in part because it can't find the staff. So it says it's 35% understaffed. So, that is all very inflationary. You're going to have to bid up for staff. And we've seen in previous episodes how the number of job openings exceeds the number of unemployed in the US. So that's wage inflation. And we push back strongly on the idea that this is going to be transitory. And in emerging markets, the tightening cycle has already begun. So central banks have started to raise rates. In the US, inflation expectations are still rising. We saw earlier in the tables how PCE inflation is now running at over 6%. And we know that the rent rises, which we are seeing, have not yet fed through into the inflation statistics, and Nordea are predicting that that's really going to come through in the fourth quarter. So,
do you remember how the US calculates its rent inflation? It's over owner equivalent rent, which is they phone up a few owners and say, what would you expect the rental to be on your property? And it wasn't really changing. But this is a figure of actual rents.
Yes, absolutely.
I sort of rest my case.
Yep.
All right, so this is the reverse repo. So the reverse repo was some sort of weird arcane thing nobody ever talked about, understood, knew what it was, until 2016, and then it disappeared again. And now it's at 1.6 trillion and rising steeply. And this is banks depositing their money with the Fed on an overnight basis. And they are depositing vast quantities of money with the Fed on an overnight basis. And this is indicative of something, clearly.
Well, it's showing that the banks prefer to lend money to the Fed for, half a basis point than lend it out to businesses and consumers.
So it's extraordinary, and it's what concerns me is the rapidity and size of this increase, and the treasury cash balance, treasury general account, which Donald Trump ran up to enormous proportions. It's all been spent basically. So the US government's going to have to start issuing treasuries again to fund this expenditure.
Yeah, and that means that
QE.
somebody's going to have to buy them.
Yeah, it means QE,
yeah,
one thing, aka money printing. The financialization of the economy. So I should just correct that. QE technically isn't money printing, but it seems to have the effect of money printing when it comes to financial assets. And this graph shows the financialization of the economy. So for decades, the US private sector financial assets as a percent of GDP was between 2.5% and 3.5%. And then in the last 20 years, it's gone up to 6.3 times.
Yeah. And actually, you see, this is my concern, Richard. Everyone has got loads of financial assets. Financial assets are essentially a call on the future. And I just think that going forwards, our aim as private investors should be to try and retain what we have, because there's just too many financial assets, and somehow I think they're all going to be inflated away. And what your aim should be, the last man standing.
Yes, I agree. I think you're right, Keith. Global food prices. So I think we recorded a tick down in one of our podcasts a couple of months ago, which occurred, and now the food prices going back up. This is going to be worrying governments, including the Chinese government, because this is the sort of thing that causes huge social unrest. Yeah. And the increase has been dramatic, 20%, in the 25% in the last 12 months.
Okay, moving on to equity markets, and generally a poor week. So FTSE was down 0.9%, stocks Europe down 3.2%, S&P down 3.2%, NASDAQ down 4%. Now remember that technology companies can be viewed as essentially very long duration assets, and as interest rates rise, technology companies, their share price can be expected to come off strongly, and that's exactly what's happened. The Japanese Topix was down 5%. Bitcoin had a good week, up 8.6%, and sterling was poor, down 1.7%. The market is not taking the return of inflation in the UK very well, and sterling is selling off. So this is the NASDAQ, and that is is that the start of a trend? It's had an amazing run just as we head into October. And this is sterling, which is coming off. And frankly, we head into a stagflationary period. Britain has a history of inflation. And if you look at the long-term price of sterling, it's not a strong currency. And if you're a sterling holder, investor, it might be best to hold some foreign assets or some hard commodities.
I think that's very true, Keith. If you hold commodities and the pound falls relative to a basket of currencies, then the value of your commodities will go up. So it's definitely an insurance policy against falling sterling. Prices. So Bitcoin and Ether, the price has been incredibly volatile over the last few weeks, and I think it was down at one point. It was down 10% in a day, and now last week Bitcoin was up 8%. It is hugely volatile. I think the only way you can stay in your position is if you haven't got a particularly large position and you have faith. So I have both, i.e. not a large position and faith. We shall see. And then the log chart of Ether, which I put up from time to time, it's still way above that logarithmic trend line. If you care to think that it is following the logarithmic trend line, I wouldn't be very comfortable, I have to say, if the price dropped down to 641. And that sort of if you had a large position, you said, I doesn't count, I'm going to hold on as long as it doesn't break through the trend line. You might have a few sleepless nights as it headed towards that point. That's something to be avoided, I think. And then this article was in today's FT. Apologies to the FT for printing the whole article, but it was the last paragraph I wanted. So this is policymakers' fears reflected in Bank of International Settlements paper. So this is to do with digital currencies. And the last is a quote: "Central banks have a responsibility to ensure that citizens have access to the safest form of money, central bank money, in a digital age," said ECB President Christine Lagarde. And most of what we've been talking about today is the printing of vast quantities of central bank money. And I just think that the hypocrisy of the statement is extraordinary. And I think it's one of the reasons we're in the mess we are in, actually, is that we have such dishonest people in high positions of public office.
Okay, moving on to industrial commodities, and an astonishing week in energy markets and a mixed week elsewhere. So aluminium came off, down 2.9%, but remains very elevated. Cobalt was flat. Copper was down 2.3%, but remains within its recent trading range. Chromium continued its really puzzling run, up another 3.8%. Iron ore had a little bounce, it was up 2.8%. Lithium, we remember we covered last week how the lithium prices had been updated, and far from being flat, there has been this hidden bull run in lithium. Well, it continued this week, up 1.9%. Neodymium was up 0.8%. Nickel came off, down 5.5%. Tin came off, down 8.5%. But again, prices remain very high. Ferrovanadium has been drifting off with the decline in Chinese steel production. That fell further, down another 4.5% on the week. Crude was strong, up 1.9%. Now, gas and coal are absolutely frightening. So we've been covering their rise in recent weeks. It got worse. And these numbers are correct. So Dutch gas futures rose 40% on the week, and we'll show you the chart. Coal rose 20%. Uranium has drifted off from its recent peak.
I would just like to make a comment on uranium, Keith, before we move on to the other charts. So it strikes me that nuclear power is becoming evidently the only way forward for the world's economy over the course of the next 20 to 30 years. If we don't want to revert to, if we don't want our economies effectively to self-destruct on high energy prices. The problem is that it takes 5 to 10 years to build a nuclear power station. And I think governments around the world will be scrambling to either reactivate mothballed nuclear power stations, extend their lives, and or build new ones. And I see that the uranium spike for reasons we've discussed previously. I see that in the long term, buying and holding some uranium investments, for me, is now a no-brainer.
Okay, I'm going to push back actually, Richard, because I think the price has been really artificially squeezed up by the spot ETF buying up all the spot inventories.
And I agree with you, Keith. I absolutely agree. I think it has been, and I think that's a short-term effect. But I think over the next 5 to 10 years, governments will be scrambling to stockpile uranium because they will have to build nuclear power stations, and they will have to have the uranium to fuel them with. And I think there will be a move now to begin, for governments to begin stockpiling large quantities of uranium. And I think that will be the driving force. I completely agree with you about the recent squeeze.
Yeah. Okay.
Oh, so the Bloomberg Commodity Index, this is just a further indication of what we've been talking about. It's not quite at an all-time high. It's just a few points below that all-time high of about 2011. But it looks like it's heading to go above it, given the trends that we're seeing at the moment.
Now, this is crude oil, which had a good week, although it's drifting off slightly now on the news that OPEC Plus in their next meeting are talking about allowing some extra crude into the market. And frankly, we do need the extra crude. I mean, even though I am obviously a big holder of oil equities, I mean, the energy prices are going through the roof. And if the world economy is to keep on growing, they mustn't rise too quickly. And this is surprising given the very strong rise in the oil price, but speculator positioning remains very low. So hedge funds aren't betting on further rises in the oil price. Now, this is the long-term picture of Brent crude, and you see that actually we're in the middle of our range over the last 20 years. So they're not terribly elevated where they are.
To just make a point on this graph, Keith, if you draw a line from the June 08 peak, you can draw a pretty good downtrend line, actually, and you hit the current price is just about on that downtrend line. And you do have to wonder if it goes up to $80, $83 a barrel, is it then going to spike up back to its all-time high?
Yeah. Well, I mean, I think in the next few years, yes, it will. But in the short term, OPEC have quite a lot of spare capacity, as we talked about during the week in a separate podcast. And I think that spare capacity will be used up quite quickly if the world economy continues to normalize. But we're seeing the spike in natural gas and coal prices will have real economic effects and will retard growth.
Do you know what the substitution effect will be on oil if people start substituting oil for gas when they can?
Well, if they can, if you have the option of burning heating oil instead of gas, you will absolutely be doing it. But that takes time. You need to, very few power stations will have the easy option of converting. I don't think actually short term there's that much substitution.
No.
Now, US oil stocks are now below their 5-year minimum range, and that's very bullish. These Goldman Sachs have updated on their oil forecasts, and they're saying essentially that the real bite from the drop in capex will actually start in 2023. Now, will US shale grow enough to fill that gap is the question. And the other thing they did is they revised down their estimate of the path of global oil inventories. So they are now saying that inventories will not recover during 2022. So they've increased their demand forecasts. And when you look at the supply forecasts, Goldman have revised down their supply forecast for 20 and 22 on the back of mainly declines in the OPEC members who are struggling to raise production. That is Angola, Nigeria, Venezuela, etc.
So what this is really saying is that although Saudi Arabia has spare capacity, it doesn't have sufficient to substitute for the declines elsewhere.
Yeah, but I've got various questions about whether it is too late to get into oil stocks. And the answer is no. So this is the energy sector share of the S&P, and it's absolutely plummeted to around 3%. And so, having been, 13% 15 years ago, and you'd expect this to normalize. Now, it could normalize by technology companies going through the floor, but I expect a bit of both. Now, one piece of negative news on the week was that US oil inventories unexpectedly rose. Now, if there's so much oil demand, how come supply exceeded demand in the US last week? Well, what happened was there was a spike in US production, and US production is volatile, and that will come down next week. So you're expecting draws to resume next week. And further on the underperformance of oil equities, this is a chart showing, right, the white line is US coal prices, the blue line is US natural gas prices. So they're both up about 180% since January 2020. The orange line is crude oil, which is up about 20%. And the pink line, purple line, is XLE, which is the US oil ETF, oil equity ETF, and that's down 13%. So there's still time. Okay, moving on to some other commodities. Aluminium came off, but still is very high, and that looks like the bull channel is still very much intact.
Presumably aluminium, the production declines going on in China are going to impact on the price as well.
Yeah.
As they try to save energy.
Yes, absolutely. So, somebody wise once said that aluminium is essentially congealed electricity. And as you want to cut down your electricity consumption, you want to reduce your aluminium production. Okay, cobalt was flat on the week. Copper is towards the bottom of its trading range. Chromium continues its mystifying bull run, but it is shooting up. Yeah. Iron ore, has that found a bottom?
Probably, I would say.
Lithium, wow. I mean, that is quite a spike. And it was net up on the week, but down from its peak. Yeah. Now, S&P Platts Global are forecasting lithium demand will double in the next 4 years based on electric vehicle demand. Now, nickel is coming off. Now, we have talked previously about the contradictory indicators we are getting in nickel, in that some market analysts have been saying that nickel is in an extended period of oversupply, but LME inventories have actually been drawing down, which contradicts what the analysts have been saying. So this bull run in nickel seems to have come to an end for now. And on that note, nickel is a big component of electric vehicle batteries, but Tesla have been talking about using lithium iron phosphate batteries instead, and warning nickel producers that the nickel price can't go too high, otherwise people simply switch into nickel iron phosphate. Tin came off, but still is very high and very elevated levels. Ferrovanadium is falling rapidly as the iron price, Chinese iron production stalls or comes down. And we've covered this before, but this is an absolutely frightening chart. So this is the front month Dutch natural gas price, and it's gone through the roof. And that is on a more granular level. You remember last week we were saying, oh, it's peaked. Well,
the problem with the natural gas price from a social point of view is that if you just look at the UK alone, I mean, we're competing with the Far East for gas supplies as well, liquefied natural gas supplies. And we produce a lot of our electricity through gas-fired power stations, which was a foolish thing to have done 25 years ago. And the price is indicative of the fact there is not enough natural gas. So that means people can't heat in the wintertime, people can't heat their houses, and there are power cuts. And I think actually we're looking at some potentially very serious consequences to what's going on in the natural gas market, particularly natural gas market in the UK.
I think you're absolutely right, Richard, but they'll keep the power on. What will happen is industrial users will have to go out of business or shut down. I mean, you've seen that in the fertilizers, but that will have enormous knock-on effects. So, if you look at what's happened to fertilizers, so 2 UK fertilizer manufacturers shut down because they couldn't produce ammonium nitrate economically, but then the government has stepped in to subsidize them and keep them going. Now, that can't happen. People have to come offline and cut their energy demand.
But also, Keith, if you shut down manufacturing, then the economic hit that COVID has given it is exacerbated. You give it another hit, and that's cutting away the foundation of your economy.
No, absolutely. So returning briefly to this chart, actually, This was the pattern last week, and we thought it had peaked, and then kaboom. And actually, this is this morning. So it's not coming down. And this is the UK. We're connected to Europe. We're not immune from this. In fact, as we showed on the electricity chart earlier, we're even worse. And, this is the cause in one chart, basically. This is European natural gas production. And, it's fallen by a third in 10 years. And nobody is talking about boosting our natural gas production. They're talking about,
ironically, I think is it 80% of French electricity production is from nuclear power.
Yeah.
They're going to sail through this, relatively speaking.
Yeah. And we are in Europe suffering a bigger energy price shock than in the 1970s. And remember, that caused a period of social unrest and stagflation. And this is the coal price, another big leg up this week.
It's the same issue again, isn't it? Effectively, the demand is very inelastic.
Yep.
The price.
Absolutely. Uranium's coming off, as we've discussed. Richard, do you want to do precious metals?
Yeah, certainly, Keith. I mean, it's been a very volatile week for gold and silver. So silver was down, I think, 4% at one point during the week, and it's regained quite a chunk of it. Gold was down 2% one day last week, and it has regained most of it. Hugely volatile. I don't really understand why they're so volatile. There doesn't seem to be any reason for that level of volatility. You would think that they would be on a steady march upwards, as with other, generally speaking, commodity indices, but they're not reflecting that yet. Rhodium has stabilized a bit, but I actually noticed it's down a chunk this morning. So I don't know, it's very, very volatile. Palladium is dropping back down, continuing to drop, and platinum also, which I think is reflective probably of the market's view of the catalytic converter market and the problems in the global car vehicle manufacturing industry.
Yeah, and I noticed that Ford had come out this morning saying they were going to close a US car manufacturing plant because of chip shortage. All of that's very bad for rhodium, palladium, and platinum.
Yeah.
So this is gold, very disappointing given the elevated levels of inflation. Silver, frankly, even worse. And silver is also needed for solar panels. So, long term, we're bullish, but it's short term, it's not looking very good. Platinum drifting off. Rhodium has started. Is that heading back down again as catalytic converter consumption will presumably take another short term hit? Palladium continuing to drift off.
Yeah.
But the big news really in the week, apart from energy prices, was the rise in yields. Now, if you've been a regular viewer of the weekly, you'll know that we've been absolutely mystified by the fall in rates over the first half of the year, even as inflation picked up strongly. Well, has the bond market finally started to come to its senses? So you see in the UK, we have had strong rises in yields across the yield curve. But bearing in mind that UK CPI inflation, not RPI, CPI is now at 4%. Yeah. The 30-year is at 1.375. They're still ridiculously expensive. There is potentially a long way to go for yields. Now, in Europe, actually, although you saw rises in the bond yields of the peripheral nations, they were really quiescent. And frankly, their 10-year yields are way below those of the UK and the US. So there's as yet no sign of recurrence of the Eurozone crisis. Now, this is...
Keith, that is because the European Central Bank is buying them.
Yes. Now, this is the UK 2060 gilt price, not the yield, the price. And you'll see that what was really puzzling us was the rise in the price of gilts across the board between January and August, even as inflation rose. Well, it's now come off sharply. And if you'd bought the 2060 gilt in August, you would now be down 10% on your price. And this is the 10-year gilt yield. And that's looking quite sharp. That's looking like it's on a rising, strongly rising channel. Who knows where it'll peak?
Who is buying these gilts with a real yield of -3%?
I've got no idea, frankly. The thing is, I think they're idiots, but I want them to continue because we need somebody to buy our debt. And, you know, I sure as hell ain't. Yes. Not at these yields.
No, it's extraordinary.
And this is the US, which has also risen, but nowhere near as strongly. And finally moving on to the seasonality chart. And I'm afraid, boys, it's not very reassuring. We're moving into a dangerous period of the year. And on that note, Richard, your activity this week.
Okay, thank you, Keith. So I was very inactive this week. So my weekly change was up a tiny fraction. So my shares in gold and silver miners have been badly hit, and my shares in some oil shares and also some coal shares have done reasonably well. So the net effect was not very much. So my change for the year is up 10.1%. And I had no purchases and no sales.
Very good. And you're outperforming the index, Richard. Well done.
Thank you, Keith. How about you, Keith? How did you do this week?
Well, I had a good week. And regular viewers will know that I have a big position in
well done, Keith.
Oil and gas stocks. And so, having underperformed absolutely everyone all year, I have now reached Richard's level of performance, but with much more volatility. So I now, like Richard, have performance of 10.1%, and I've beating the all share, which is very nice. And I did have a bit of activity this week. I continued to sell down my Pharos Energy, in which I've made a small loss. Now, Anglo-Asian Mining came out with actually a very good update this week, saying they'd got some new contract areas. But one of the main reasons I bought it was the Suitali contract area, which they had recovered after the end of the war between Armenia and Azerbaijan. And actually, they've given up trying to get hold of that area, which is in the under the occupation of Russian peacekeepers. So, but above all, one of our Discord members, Ali Baroid, pointed out that I was assuming that the war between Armenia and Azerbaijan was over. And apparently, the Armenians are searching the world for drones in order to regain parity with the Azerbaijanis, at which point they'll try and get everything back. And I thought, he's right. I should trim this position. So I did. And the big sale I had in the week was Norcross, which was actually a decently sized position and is a UK manufacturer of shower and building fittings, basically. And I stupidly sold. So at the bottom of the COVID epidemic, I bought a lot of UK house builders. They're about 30% of my portfolio. Now, in December of 2020, when Bozza said that we were going to have a hard Brexit, I sold the lot because hard Brexit would mean enormous supply chain disruption. And frankly, I didn't get back in when that risk passed, and I sold the vast majority of my building companies at well below their peak. I've held on to Norcross, but now that we are seeing, frankly, I think we're going to see enormous disruption from rising energy prices. There's supply chain disruption. Time to sell. And it's my last remaining property stock, and I've made a very nice profit on it. Thank you very much.
Very well done, Keith.
But what have I bought? Well, you'll be unsurprised to learn that I can't help myself. Essentially, we are in a stagflationary environment, and gas has gone through the roof, coal has gone through the roof. Frankly, it is just a question of time before oil goes through the roof, unless the world economy turns over first. So all these shares are frankly dirt cheap. So there's i3 Energy, which we are doing a share talk on shortly, and I will save discussion of that till later. Wood Group, which is an engineering consultancy with big exposure to the oil and gas sector, but also to renewable energy, and its shares are absolutely bombed out, and I expect that CapEx to start returning and Wood Group's shares to turn up. Petrometad we have covered, and I continue to add to a losing position because I think that they will eventually get their well on stream. Empyrean is interesting, and I have not previously held the shares, and Empyrean are drilling a well offshore China in Q4, which has between a 10 and a 40% of coming through. And if it's successful, will be absolutely transformative. And finally, I have bought the riskiest oil company in the world, Occidental Petroleum. Now, stepping forwards, Occidental Petroleum, you may remember, spent $55 billion last cycle buying Anadarko just before COVID hit, and are hugely indebted, and therefore very highly geared to a rise in the oil price. So, I have bought a little position. Now, actually returning to the performance of my portfolio, this is the performance of my portfolio. It's the orange line versus the all share. So you'll see that actually I've serially underperformed the all share. And actually, it is not so long ago. It's only 2 months ago, actually 6 weeks ago, since I was actually down on the year when we had a sell-off in the oil and gas sector. And since then, my portfolio has shot up 10% in 6 weeks, and I'm now just ahead of the all share.
Very good. Well done, Keith. You stuck to your guns.
Yeah. And I am adding to the bet, as we've seen, Richard. So this is Norcross. I bought it down here, and share price seems to have reached plateau. So happy to get out. This Anglo-Asian Mining, which has gone, frankly, nowhere since I bought it. This is Occidental, and this is Empyrean Energy. And the well is in Q4. And that's it. So thank you to everyone for watching through to the end. Please can you press like and subscribe to our channel. Thank you to everyone who turned up for our drink during the week, which was a great success. And we will be doing it on a quarterly basis. But in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.